Welcome, everyone. We are in a very small group here. I think more people will kind of like join us as it goes. It was meant to be indeed like a small group for like an interactive discussion. So we hope you will enjoy this. My name is Boris Le Montagnier. I'm the head of like strategic project at Building Bridges, and this is the first webinar of our series for the year. The next one will take place on June 3rd, and it will be on nature risks. Two others will follow throughout the year in September and October. And from September 30th to October 2nd, we will have our flagship event, Building Bridges 2025. The registration and program will be released next week on June 19th. Today's, like, as I was mentioning before, the outline of the session is a little original for a webinar. We'll start with like a keynote, followed by a panel discussion, and then breakout groups before coming all together. Depending a bit on the number of people, maybe we can adjust this, and maybe we can just have like an open discussion, depending a little bit on like the number of people that really want to come in and interact. Allow me to introduce you first to Aurelia Fay, our keynote speaker. She is the Senior Sustainable Finance Expert at Assets Management Association Switzerland, AMAS. Our moderator, Michal Bartek, Senior Lead Equity Guidance at Principal for Responsible Investment, UNPRI. And last but not least, our two panelists, Juan Salazar, Senior Engagement Specialist at Pictet Assets Management, and Laure Philippon, Head of Investor Engagement at ShareAction. They will all take the floor as the webinar goes on. As I was saying, there should be like 4 breakout rooms. You will automatically be assigned should it be the way it moves forward. And then in case you want to kind of like be in a different breakout room because the topic is more of like better interest to you, you can just like get out of this room with like a little button at the bottom right of your screen where you can change breakout room. So the 4 breakout rooms will be led by Laure. It's from Codes to Consequences, how to ensure stewardship codes leads to tangible impacts. The second breakout room is about building effective engagement strategies. What's in planning, dialogue, and accountability is essential for successful engagement. It will be led by Juan. The third breakout room will be escalation in practice. What happens when engagement fails? This will be led by Aurelia. And the last one is stewardship beyond public equities. What can we learn from alternative asset classes? By Michal. So yes, this is not set up as a classic webinar and more as a meeting. So we invite you all to switch off your mics for the time being. But you can put your cameras on, as we will kind of like try to increase the interaction as much as we can. We will most likely not have an actual Q&A at the end. If you have questions and comments, you can maybe put them in the chat. And if there are some of these questions or comments that are kind of like really like popping up and everyone seems to kind of like have a very strong interest for them, then I will bring it, maybe I will try to bring it if time allows, to the discussion. And I think this is it for all the like housekeeping. I wish you all a great session, and I think I will give the floor to Aurelia. Thank you very much.
Thank you very much, Boris, and good afternoon, everyone. It's a privilege to stand before you today to discuss a subject that cuts across finance, responsibility, and the future of our planet, elevating investor stewardship for a sustainable future. So in a world increasingly defined by environmental challenges and governance complexities, the role of investors has never been more critical. At its core, investment stewardship is about accountability. It's the active use of ownership rights, voting, and engagement to promote long-term value creation, not only for shareholders, but for the environment and the society. In Switzerland, the Swiss Stewardship Code, introduced by AMAS and SSF in October 2023, is a clear and timely response to this need. It outlines 9 principles that promote purposeful engagement grounded in the idea of double materiality, that sustainability affects financial outcomes and that investments impact the world around us. That is really stewardship with both depth and direction. But stewardship, while powerful, is under pressure. And to understand this, we need to consider how investor influence has evolved. Back in 2028, the global financial crisis was really a wake-up call. It revealed the danger of short-termism and unchecked risks. In response, we saw the rise of active ownership, tools like proxy voting, say on pay, but also formal stewardship codes, including in the UK, became common. And stewardship became very much embedded in many investment strategies, especially in Europe, and increasingly as well in Asia. Today, that influence is facing growing resistance. Dual-class share structures are diluting voting power, limiting shareholder influence. Corporate pushback is increasing, with some firms resisting ESG demands as political posturing. And in the US, political polarization has made stewardship and sustainability more broadly cultural and regulatory flashpoints. Legal risk, regulatory scrutiny, reputational fears are also prompting some investors to pull back. So we see a geographical split emerging, Europe and Asia continuing to push forward with stewardship and sustainability generally, while the US shows growing skepticism, with some states even penalizing sustainable investing. So this is not just a legal or political issue, it's a strategic one. If stewardship is to remain a core level for change, investors must defend its legitimacy and reinforce its value proposition to both markets and society. So in response, stewardship needs to evolve. Stewardship today must be even more strategic, more contextual, and even more business relevant. The focus should be on targeted, high-quality engagement, focused on material issues, sector dynamics, and the long-term value proposition. It's about shifting from quantity to quality, fewer engagements, but deeper, more informed, and impactful ones. And it's about really coming back to the roots of sustainable finance, understanding the company's context, its constraints, its market, its stakeholders, exploring where sustainable goals can actually create value, not just compliance. It's about having nuanced conversation that acknowledge trade-offs and complexities. So it's not enough to pressure companies. It's about investors really must partner and continue to partner with them, understanding their challenges and opportunities through contextual conversation. This is not engagement for engagement's sake. It's stewardship that is business relevant and value driven, which would ultimately make it even more credible. So here in Switzerland, we are seeing this approach in action. The Swiss Stewardship Code published in 2023, as mentioned, is principle-based, voluntary, but it is already starting to catalyze better practice. It moves us away from a checkbox exercise and towards a more outcome-driven engagement model, with outcomes being a clear part of the stewardship definition of the Swiss Stewardship Code. Yet codes are a great first step, but they're mostly paper. We need to turn those paper into real-world impact and action. And this is really where collaborative engagement initiatives and all of the work that investors are doing is so key. This is in that context that AMAS basically developed a collaborative engagement initiative in the form of the AMAS engagement letter. The goal was really to identify the themes on which investors in Switzerland would like to pool their efforts and collectively call on Swiss companies to adopt standards. And those themes range from corporate governance to climate, biodiversity, and also just transition standards. This initiative was published and was started actually in December this year with the publication of a letter that is not legally binding, but we already have 8 investors that are part of this Swiss Collaborative Engagement Initiative, which is very much stewardship in action. The mentioned initiatives are basic steps, but they are example of how voluntary principle-based approach can actually foster and start fostering corporate dialogue. And because Switzerland is also globally connected and yet politically neutral, it's uniquely placed to lead a pragmatic, credible stewardship model that other markets can also learn from. Internationally, we are indeed entering a phase of recalibration. In both the EU and the UK, regulators are responding to the feedback that stewardship reporting has become overly complex, burdensome, and difficult to compare. As a result, the UK Financial Reporting Council, the FRC, has actually streamlined its stewardship code in a new version that was published last week and that is effective from January 2026. And in this new version, the revised definition of stewardship no longer implies that stewardship encompasses a duty to deliver societal and environmental value. And this is a crucial shift, which makes the UK code slightly less ambitious than the Swiss one or other, for example, where double materiality remains key. It, however, reflects a growing consensus that for stewardship to succeed, it must be practical, outcome-oriented, and scalable, not an administrative burden. So let us be clear, stewardship is not in retreat, it's simply entering a new chapter, more complex, more scrutinized, but also more essential than ever. So to elevate stewardship, investors must embrace a vision of stewardship that is focused on real-world outcomes, informed by business context and long-term value, and resilience in the face of political or regulatory shifts, and ultimately and above all, transparent and therefore credible. Stewardship should not be abandoned in moments of pressure. It should be refined, reaffirmed, repositioned as a strategic and responsible pillar of sustainable investment. So we stand at a critical juncture. The pressure on stewardship is real, but so is its potential. So we do not need more framework for the sake of frameworks or regulations. We need stewardship in action that delivers impact. We need engagement that drives progress. And we need a system like the one Switzerland is building that balance clarity, flexibility, ambition, and purpose. So let all of us here with this conversation serve as stewards of sustainability, of long-term thinking, and of a future in which finance and purpose are one. Thank you.
Thank you, Aurelia, for this overview of the Swiss Stewardship Code and explaining how it fits into the Swiss context, the global context, and how it fits into the shifting sort of global trends. So thanks very much for that. So I'm going to now sort of switch attention to sort of a closer look as to how stewardship looks like in an asset management firm. So I would like to turn to Juan and basically ask him, how is stewardship evolving within your organization?
Thanks, Michal. Hi, everyone. Thank you for being here this afternoon. And Aurelia presented a really clear case on why stewardship needs to evolve and why we need to, take bolder steps towards making it more effective. And what's been happening at Pictet over the last, 3 to 4 years, and we expect this will continue evolving going forward. I would focus on 4 aspects. Firstly, our philosophy at Pictet is that active ownership, and I'm going to focus on the active ownership aspect of stewardship. Active ownership, i.e. engagement and voting, should be owned by the investment professionals themselves. We have a small responsible investment team which has the sort of intention and their mandate to support investment teams in understanding these complex issues, for example, nature, climate change, human rights. But it should be on their, part of their responsibilities of the investment teams to conduct the engagement and the voting themselves. What we have seen over the past 3 years is that ownership getting more, clear, more evident, and this has been via this investment professionals realizing that the information that they gathered through engagement actually can enhance their analysis of the companies they're investing in. It's also been due to incentives, sort of encouraging them to actually do the engagement. Client demand is a key driver. and capacity building. So we have a really structured training program to all investment professionals and other functions within Pictet to upskill them in engagement and voting. The second aspect, and this really I mentioned this, is the shift from quantity of engagements to quality. You know, it's been a while that asset owners and other clients, they want to see engagement numbers, and you know, they usually, and this is probably not the best way to do it, they compare amongst asset managers to see who does the larger number of engagements. Sorry, and we sort of couldn't completely avoid falling into that trap to engage more, but we've come to a point where the focus is clearly on quality, and we're gonna go forward with that. It's not that we're not gonna see or care about quantity anymore, but there will be a clear focus on what is material, where is it that we can effectively drive change and pursue those engagements. Thirdly, we are slowly but surely expanding our engagement activities to beyond equities. I mean, equities has been I guess the easiest way or asset class to do engagement, and it's across the industry. But we have been making good inroads in the past year on engaging in corporate and sovereign fixed income. And we are dipping our toes on private markets, which is a booming asset class. And lastly is our continued support and active participation in collaborative initiatives, which we think are an essential tool of our for engaging.
Did want to ask about the collaborative initiatives, but you know, you've touched on that topic, so maybe we can come back to that in a second. But I would like to turn first now to Laure and ask her basically about exactly that, about you know, her reflections on collaborative engagement initiatives, and also, you know, what are in your view the limitations in investor stewardship, and how can policy frameworks and investor coalitions help overcome them?
Thank you, Michel, and thank you all. I'm very happy to be here with you to discuss this very key topic, and congratulations, Aurelia, for the work done by Amas on the Swiss Stewardship Code. So one of the main limitations on investor stewardship is clearly the weak effort to hold individual companies accountable. For example, stewardship that doesn't have a meaningful escalation plan. So on our side at ShareAction, we published end of 2023 a paper that is part of our Responsible Investment Standard and Expectation series, and that provides an escalation toolkit to engage with companies with different steps. And we'll see that investor coalition and collaborative engagement is clearly key in this process. Because when we start engagement with a company, the very first step will be to have regular meetings and call with the company, setting clear and time-bound expectation. And then to escalate, the tools can be done alone, such as, for example, a vote against director or a final decision to divest, but which will mean that the engagement was not successful, in fact. But there are some very effective tools that are also available thanks to this collaborative engagement. So that will be collaborative calls and meeting with the senior management, collaborative private letter to the senior management or to the board, a collaborative public statement, and lastly, for example, to file a shareholder resolution. And so we see that collaborative engagement can be a key step in the escalation process, like putting more pressure on the company thanks to a bigger share of capital represented by the asset manager. But another limitation relates to a stewardship that focuses only on one individual firm when we need a sectoral approach. And a lot of risk in sustainability are systemic and can not only fixed by stewardship that focus on individual stocks. So at the other end, we need to start somewhere. If you focus stewardship effort on key players in a sector, it's possible to create the condition for raising standard more like widely across the sector. And this is where collaborative engagement can also play a key role by like allowing to share resources and to engage with more companies at the same time. And to go to the second part of your question related to policy, clearly stewardship is more effective when it's supported by complementary policy measures that will help create a level playing field, reinforce responsible corporate behavior. So in other words, to kind of truly lift all the boats, stewardship effort must be matched with a conducive regulatory environment. And this is why at Direction we think that investors who are really serious about stewardship should also engage and participate actively in policy advocacy. And maybe I will conclude with another thing that is not really linked to collaborative engagement or policy advocacy. We also see that there is another limitation to stewardship. This is like the conflict of interest for some asset manager, because like they cannot they all back because they'd like to do some business with the firms in their portfolio. We see also that some of them regard stewardship as a cost burden rather than seeing it as a competitive advantage that wins them business. So there is for us clearly a message to deliver from the asset owner, and maybe that asset owner should like reward business to asset manager on the basis on stewardship excellence.
Okay, interesting. Yeah, you've reflected on a number of points regarding escalation, coalitions, and policy engagement, and also the topic of conflicts of interest. Juan, if I could get back to you, would you like to reflect on anything that Laura has explained, and in particular, what is your take on the broader policy engagement?
Yes, sure. Thank you. In terms of collaborative engagement, I guess the only thing I would like to add to all the points that Laura clearly laid out is that they allow for two things. They allow for peer-to-peer learning, and which is essential, especially given the increasing complexity of the issues that we're dealing with. So, one clear example is nature and biodiversity. It's the fashion, it's everywhere, but understanding what it is about, how to tackle it, how to have meaningful conversations with companies is hard. And that can be made a bit easier by talking to other investors, being in the same room, aligning the expectations that we have from companies, and speaking with a consistent voice. All of this put together really amplifies our voice, and that's why we are so keen on these collaborations. In terms of macro stewardship or engagement with policymakers, I don't have a lot to add. I think it's critical that investors do it. It requires a slightly different set of skills and probably a higher level of ambition in advancing your responsible investment commitments. But we cannot escape from doing that. And at Pictet, we have been doing it for especially over the past couple or 3 years. And the main avenue that we have used to do that is, again, through industry association, through AMAS, for example, through the UK's investment associations, through Umedian in the Netherlands. I think those forums and those associations have, they have identified the main avenues through which to conduct this engagement in an effective way. So we add our voice to that rather than doing it ourselves. But again, that doesn't mean that we will never do it just as Pictet being vocal about an issue or another, but that's it. The approach that we've taken so far is through our membership in these associations.
Okay, thank you. If I could go back to Laura and basically ask if she would like to add anything regarding the the impact and limitation of one's actions as a civil society when it comes to engaging financial investors and the real economy.
No, thank you. So Abshare Action and some other organizations, our first impact is really done by convening some investor coalition to engage with corporate and banks on real economy issues. So I will give an example. Recently, we filed a shareholder resolution together with many asset managers with three UK retailers on living wages. And so the first AGM was a few weeks ago. The resolution obtained almost 27% of votes in favor, which is quite a serious level of support for that kind of resolution. And the company is now legally obliged to respond to the resolution and clarify how it will act on investor concern. And so I feel that this is a topic for which we could convene an investor coalition, but I'm not sure that the investor will have do something on living wages without the help of Share Action. We also regularly assess and benchmark the asset manager. We publish two key reports. The first one is an annual one on voting, which is called Voting Matters, that was published in February. And it assessed the vote of 70 asset managers. And the other one is published every other year, which is called Point of No Return Benchmark. We published it end of May, assessing the performance of 76 asset managers in terms of responsible investment. And engagement and stewardship is one of the 4 areas that are assessed. And all of this is done thanks to our financial independence of the investment industry. It gives us really real advantages. We are free to highlight the problems and the poor sustainability performance of some investors and companies without any fear or favor. And so in terms of limitation, on the other hand, we cannot easily scale what we do as we don't have a commercial business model. We are a team of 100 people. We are limited in tackling the mass of actors in finance and in the corporate community may deserve to be held accountable. So that's it. For me, this is at the same time something very positive for the impact that we have, but something that is a limitation. But anyway, even at the scale we operate, we can demonstrate that what ambitious stewardships look like, drive ambition amongst some major players, engage with policymakers, financial supervisor. So we believe that this is important, even if we have some practical limitation in terms of reach.
Great, no, thank you. Thanks very much for those honest reflections. And if I could come back to you, Juan, we keep hearing about AI, artificial intelligence, many times every day. And we all wonder what it means for various aspects of our lives across industries. Does it play any role in terms of Pictet's stewardship efforts?
Not yet, but it will start to playing a role in, firstly, enhancing investment teams' ability to identify material ESG risks and opportunities and how companies are managing them, and critically to help us better monitor and track our engagement activities, because currently it's a very manual exercise. For example, we meet a food and beverage company today and we ask them to set up a specific water targets by 2030. Then we have a conversation in 6 months, like how you're progressing. And the company, yeah, we're thinking about it, you know, but then one day it sort of comes out that they set the targets and it's in their sustainability report, but we didn't, or investment managers didn't necessarily read the sustainability report or didn't read the whole annual report. So we might miss that actually the company made that change. So it's kind of like helping us, or we expect and hope that it'll help us better track that, set predetermined milestones that are going to be easier to track, and that, you know, in the end, we're going to be able to hold companies more accountable, and at the same time, our clients will also be able to hold us more accountable for our for the outcomes and the impacts we have with our engagement. So it's work in progress. Hopefully, we'll get to incorporate that fully into our approach. So.
Okay, no, that's interesting. Yeah, because we hear a lot about how various entities are experimenting with the use of AI to basically aid the analysis of investments, analysis of companies, and obviously identification of relevant ESG risks is part of that. But it's interesting to hear that you're considering using it to track engagements and also basically measure the impact, if we can call it, impact. So that's very interesting. No, thank you. Thanks very much for that. I'm not sure, Boris, whether we would like to, open things up for additional comments or questions, or whether we would go through some of the subtopics, like stewardship beyond public equities, or further reflections on the codes. How to ensure that stewardship codes actually lead to tangible impacts out there.
I think, yes, thanks, Michel. I think we can try to move into like small breakouts and like see how everyone wants to contribute. And in case like I will be floating around, so to kind of like gauge how it goes, and maybe if depending on how it goes, maybe we kind of like end like these 15 minutes that we have, or we have in fact like more like 10 minutes in any case in the breakout sessions now. And then we kind of like reconvene when time seems right, but in maximum 10 minutes anyways. Will be about like, I think 4 people per breakout sessions.
Okay. Okay, we're getting back into the main meeting, and when we're all back, we will go around from the breakout leads and hear their reflections. Are we all back in here? I think so. Okay. Would like to start with a bit of an overview of what you've heard in the breakout session. Juan, are you leading one? Okay.
Our time flew. I just went into the ether, and we didn't have a full-on discussion. But anyway, I proposed that to build effective engagement strategies, we need to think about 3 critical aspects. The first one being to have a clear vision and purpose of what we want to achieve with the engagement. Secondly, to build trust with companies by entering an engagement as a two-way dialogue rather than just a list of demands that we have from the companies. And thirdly, to be better at holding companies accountable. So we didn't discuss all of them. The one that we spent the most time was on the vision and purpose, and it became clear that investment teams need to be part of this process in whatever shape or form, ideally leading it themselves and owning it themselves, as I explained before. That their involvement is key to articulate the objectives and goals of the engagement in a way that reflects the business strategy and the priorities of that business. And as we're discussing in the beginning, that will allow us to have more nuanced and potentially more meaningful conversations with company management, because we will be able to articulate these objectives in a way that resonates with management. So that was something that we discussed. The other thing that that was brought up was involving our clients, asset owners, in having sort of better communication with them in terms of what their expectations are beyond, oh, you have to engage with our companies and you have to report on that. That's easy, but it's about what expectations do they have, more concrete, and how do we integrate that into the way we do engagement with portfolio companies. And we also had a brief chat about how to hold companies accountable. This is basically about setting milestones throughout the engagement process, keeping the communication channels open with them, being ready to escalate when it's necessary. In that way, we hold the companies accountable, or we can better hold the companies accountable to the changes that we want them to affect. But at the same time, it allows us as asset managers to be held accountable by our clients.
Yeah. Okay. Interesting. You've covered a lot in that breakout. I wish, in our group, we run out of time very, very soon. Aurelia, any reflections from your one?
Sure. I was also going to say, we may not have had the same 10 or 15 minutes in the same in the room. So on our side, I mean, we didn't get the chance to have two comprehensive conversations, but we started on the topic of escalation, basically reflecting on what also Laure mentioned earlier in terms of what to do when engagement fails, and the different kind of steps or mechanism that you have that investors have at their disposal to put more pressure on the company. We went through, I mean, the different basically mechanism all the way from voting against a board member, sending letters to management or even to the board, and then all the way to divestment. And it was interesting. And I mean, we just got cut when we had this point that was kind of covered. But what we also discussed is that it's not necessarily sometimes effective to put more pressure in that sense. But one participant mentioned the fact that sometimes it's more making it clear and kind of putting the carrot to why is it so useful to do whatever you are pushing for when you engage. But that's at least what I understood. But then we got cut. And maybe just a few. One point is that I think it was also, I mean, just sharing also a thought. I mean, we had yesterday a great session, roundtable between AMAS and PRI in Basel with stewardship professionals, and it was on escalation. And it was interesting to see, and maybe just to share that with the broader group on that side, that basically it's not as mechanical as it seems. And sometimes one approach that works very well in a certain case, in a certain asset class, in a sector, may not be at all effective in other cases. So it's interesting to be creative, and I think that was also one of it's not rocket science. You have a lot of tools at your disposal, and it's really about ensuring that you do the smartest or the most smartest move in that particular context. So I think that's maybe one key learning that I wanted to.
Okay. No, thank you. Thanks very much for that.
Yeah.
Okay, and now finally, let's go to law and find out about the codes and consequences of codes.
Yeah. So for us, that was quite short too in terms of time. But anyway, so just to mention that, like, one participant suggested that there should be a regulation forcing asset manager to allocate more time to stewardship. So yeah, why not? Let's go for that. And we also had a discussion about like the responsibility of asset manager versus asset owners. Like in the end, these are the asset owners that indeed own the asset and should be like maybe more involved in the process. So it depends what it means by like being responsible for this, because it's quite challenging for some asset owner who do not have the capacity to engage with company, etc., the resources to do the stewardship, to implement the stewardship process. But so, yeah, we had a chat about the fact that maybe they should ask for more. They should maybe select, as I said before, asset managers that are indeed implementing good stewardship practices, and also be ready to pay for that, because we still see some asset managers that are supposed to be keen on implementing more stewardship, but in the end, they do select asset manager based on the cost. And we see, for example, that the big ones in the US that are kind of changing their stewardship policies right now or adapting are the ones still getting some mandate because the costs are like really low. So yeah. But clearly, indeed, the discussion to have with asset owners on this.
Interesting. No, thank you. Thanks very much for those actually very interesting reflections. I mean, in our group, we were touching on stewardship beyond public equities, and so because ultimately stewardship tends to be associated with listed equities, but in reality, it's expanding, and there's growing realization that it can be attempted or done in relation to corporate bonds or even sovereign bonds, and PRI is running several kind of pilots in this sovereign engagement space. And when it comes to kind of private markets, we haven't really reached any conclusions about what one can learn from the stewardship in private markets, but it certainly is relevant. And despite the fact that many people may believe that stewardship in private markets is kind of something, say, general partners do anyway, because they have very close contact and close links with the investee companies, there is quite a lot that can be done and that one can learn about from others. So it's quite obvious that when in private market space, the sequencing or the time horizon or the time frame of the investment is a bit different. So different stages of the investment process work slightly differently, but in terms of the actual tools and mechanisms through which one can carry out stewardship are quite plentiful. And over the last year or two, we've seen a number of entities, including the PRI, basically publish research in this space, or guidance, or at least reflections of findings from close work with a number of general partners. So, and the other thing we've realized is that for people who are used to talking about stewardship or who have worked in stewardship for many years, there is nothing particularly new about some of these observations and findings. On the other hand, for those entering the industry, there is actually a lot to learn when it comes to the stewardship techniques, the mechanisms of engagement, the timing. There is a lot to comprehend and a lot to do if one starts from a low base, or if one is an investor that previously hasn't done much in this space. So perhaps I could just very quickly capture some broad takeaways from today. It was very interesting to hear about about reflections on how it is possibly best done in terms of organizational arrangements. It was interesting to hear that it's the investment analysts and investment decision makers who should be closely involved with the engagement topics and engagement activities. It was very interesting to hear also that in terms of the actual approach, no one particular way of doing things is ideal. It's scenario or situation specific, what works, what doesn't work, or which escalation techniques are likely to lead to actual outcomes. And it was also interesting to hear about the call for greater resourcing to be devoted to stewardship, and maybe potentially the need for asset owners to be willing to basically pay for the stewardship activities that asset managers are offering and capable of. And lastly, it was also interesting to hear about how AI is entering the picture from the point of view of the monitoring, tracking, and stewardship topic identification process. So thank you.
Thank you very much, Michel, for like these last words. Thank you very much, Juan. Thank you, Laure and Aurelia, for like all your great contributions today in this small group where we had the chance to kind of like interact on a more like personal and like small scale level, which is very interesting, I find. A last reminder that the Building Bridges 25 program will be released next Thursday on the 19th of June. The event will take place on the September 30th to October 2nd. So you are like invited to like register and like have a look at the program from like next week if you're interested. And we gonna just send you, as soon as you will like close this Zoom call, you will be sent like a little survey. If you could take a minute to kind of like fill it and tell us a little bit how your feedback in order for us to kind of like maybe better design these webinars for like the community. So thank you very much again to all our great speakers today, and thank you very much to all of you in the call.